We're still focusing on phasing in versus lump sum investing with my three guests: Henry van Deventer, Head of Financial Planning at Access; Roland Rousseau, Equity Strategist at Absa Capital; and Kobe Lekranji, Fundamental Analyst at Access. And Kobe, perhaps we should just wrap up a lot of the reviews that have come through by looking at specifically at what we see in the US.
Yeah, I mean, again, let's just quickly wrap what we said in the beginning part of the show. Bill Jones did some research in the US, looked specifically at lump sum investing versus phase-in periods, and he looked specifically at various periods. He looked at 6 months, 12 months, 24 months, and 36 months. And if you look at your screen now, you'll see some of the actual findings of that study. Investing in equities should be a long-term decision. I think, Roland, you made that comment quite clearly in the first part of the show. Phasing in protects against a drop in value in the first few months. 12-month phasing in is effective if the decline occurs within the first 8 months. And then phasing in is not effective over periods longer than a year. And it's probably better to lump sum, because if you lump sum, probably over time, you're going to make more money.
Okay, so Roland, with regards to what we could be seeing here in South Africa, let's touch on the volatility here in South Africa and whether it is worth phasing in over 12 months.
Well, volatility needs to be managed, and one way to do that is to not try and time the markets, because you will potentially get swung by that volatility. So dollar cost averaging will smooth that ride, but it's not giving you a return benefit necessarily, as we've discussed. So it's a sleep easy strategy, but it's not necessarily a
so in the South African case, you're still more prone to moving towards a lump sum investing.
I think it's valid in South Africa even more so than in other countries, because we have structurally higher volatility as an emerging market. We also have to probably consider what we do with an offshore allocation. Do we need an offshore allocation if we in retirement? And that because there's lower volatility in those markets. Again, it's an equity kind of cash bonds equity decision as well. I don't know what you guys advise for offshore allocation post-retirement.
Well, the offshore allocation argument is an interesting one, because from a volatility perspective, there are two sides to the coin here. You know, the one is, what do the foreign markets do? The other one is, what does the exchange rate do?
In the last few years, it wouldn't have been a good idea.
It would not have been a good idea at all. I think if we're going to take this argument and try and divorce it briefly from currency specific or equity or asset class specific, I think there's an overarching principle that comes out here that we need to bear in mind. The overarching principle is this: how do I deal with volatility, whatever the origin of that volatility, to give myself the best possible chance to be in the position that I want to be in? The more volatile the asset class, potentially, the more significant the impact of making a lump sum decision. So firstly, to answer your question, Roland, this applies very much to offshore assets as well. But by and large, whether we experience a volatility in my portfolio based on what's happening here or what's happening abroad, I just want to give myself the best possible chance of not buying
But it's about diversification, really. So your offshore allocation, to some extent, provides higher diversification, irrespective of what currencies are doing in over a 10, 15-year period. In the short run, I agree with you. Over a 5-year period, it can create even more.
But I mean,
risk.
I think the bigger issue though is it diversification at the expense of the objective? Because I think one of the big issues with investing is that people sometimes invest without an objective. So people go into markets and say, I'd like to make money, or I'd like to maximize my return, and that's not necessarily an investment objective. Relating an investment objective to inflation in the country and trying to make money beyond that,
so beating inflation in the long term, essentially.
Beating inflation, but then also by certain margins, immediately links it to the cost of living, but it also links it to a specific lifestyle event, or it links it specifically to your own liability driven. Now, if you're diversifying globally, but at the expense of this, then you're over-diversifying and you're potentially then taking on more risk than you should really be taking on.
But I mean, we've also got to take into consideration that when you invest a lump sum amount, you are going to invest in various asset classes, and usually equities takes a large chunk. So let's take a real example. In March 2008, the JSE All-Share hits an all-time high of over 33,300 points. Not too long ago, we hit over 34,000 points. If you had, I mean, what were you advising clients then? Put a big allocation towards equities, and then only to see your money deteriorating, and over 3 years you haven't done very much on the equity front. I mean, how do you protect yourself from the externalities that we could actually see affecting the equity market?
You see, I think the big issue to take into consideration is somebody that invests in 2008 is trying to invest for the long term. So they're not necessarily trying to make money over the market over the next year or the next 2 years. That would be nice. And that would be a great thing to do. And I remember a couple of shows ago.
But you're still drawing down your capital on a yearly basis, though.
yes, you need your, incorrect. So if you're investing in such a way that takes away from the fact that you can take this income if you are if you are retired, then you're potentially wasting your time investing in such a way. If you're investing in such a way that despite this fall in the market, that you've diversified to the point where you can continue to take the income, then potentially you're doing yourself justice, regardless of the dip in the market. The problem that you face is that a lot of clients that invested kind of in midpoint 2008 is looking back over time and saying, well, right now, for the last 3-4 years, I haven't made any money and I've taken 5% of my capital. Shouldn't I have rather phased in my money? Now, potentially we get another bull run, Henry, for another 3 or 4 years. Maybe clients will stop asking the phasing question. People say, no, just put my money in the market, it's fine. You know?
Which, by the way, in itself is ironic, because people stop asking, should I be phasing in, when they should be asking that question most. At the end of a bull run cycle.
What are you advising clients now, given the fact that the JSE is sitting at above 34,000 points?
Well, I tell you what.
And it's just one asset class, though, that we're looking at.
I tell you what, to answer that question, let's look at the research. Here's some research that was done in the South African market. It was done by Axis, and it looks specifically at phasing in and how many times it beats lump sum investing. Now, the only difference in this study is that what we're doing over here is we're assuming that you'd be invested for at least a 12-month period. So let's have a look. If you look at your screen there, you'll see a range of blue bars, and the blue bars indicate the percentage of times that phasing in outperformed lump sum investing. And the period there again is 1960 to 2010. And if you have a look at it, there you can see the answer there, 37%. So if you phased money into a market over 12 different installments, and you then looked at how many times you beat the market, you only beat the market about 37% of the time, as compared to actually putting in a lump sum right in the beginning. And you can look at some of the other data over there. If you've decided to phase in over 6 months, you only beat, and that's now obviously measuring it at a 12-month period, you only beat again about 37% of the time. We've rounded those numbers back to kind of their, just to 2 digits. And that's why you can see there's no correlation necessarily between the actual number and where the bar is. But that gives you an indication. So phase into the market, longer than 12 months, you're probably wasting your time. On 12 months, you're probably going to do yourself a benefit, but then only about 37% of the time, aka the data that we saw overseas.
Very, very good point. And in fact, we're going to put this in a practical context, because I feel that your question is still kind of hovering there. So what do we tell clients, and when do we tell clients?
Looking at the situation right now, we've got the Eurozone issue still ongoing. We've got better economic data out of the US, but a lot of talk possibly of more stimulus. There's so much that is going on a macro level. We have to take those things into consideration.
We have to take those things into consideration. And probably one of the primary variables also that we need to look at is, from a valuation perspective, let's forget about whether the Aussie is at 33 or 34. Let's look at this from a valuation perspective. If I'm going to look at earnings yields and sort of PEs and all the rest of it.
The market is sitting at a P of 13, 14 at this point, so much cheaper.
Which is fine, but which is kind of, that's your 50-year historical average. So, on average, is the market cheap or expensive? The more expensive the market gets, the more sense it starts make to start protecting yourself, because potentially, the further you can fall when a correction should come along. So, is there an absolute rule in terms of what I should be doing today and what I should do at any given point in time? I wish there were, but in its stead we have some guidelines that we need to consider. The first guideline is this. How do you feel about the values and the valuations currently in the market at any given point in time? And if you're investing some of that money abroad, of course that's a consideration that you'll take into account. Higher the valuations, the more likely statistically it would be that a phasing in strategy would make sense. So how do I phase in? 6 to 12 months we see as a sweet spot. There's a 60% chance that I'll be slightly worse off, but not significantly so. Anything more than that is actually going to be a waste. So that's my first point of departure. Second consideration for us, and I'm glad you brought that slide up, Kirby. If we look at the right-hand side column on this table, we'll see that the longer the period over which I phase in, the lower my average historical return is for that period. Roughly, for every month longer that I wait to phase my money in over, I lose on average about 40 basis points of return over a given 1 year period. So if people want to know, well, what's the price of phasing in my money? It's about 40 bips a month, if we can be as harsh as that.
Yeah, I mean, let's just quickly quickly bring that graph here into context. And this is what you're looking at, is right at the top of the end of the screen, you're looking at a lump sum investment. If you made a lump sum investment, the best return you could have got out of the Aussie is 125%. The worst return you could have got is minus 48%. And then on average, your 12-month return is about 16.9. Let's call it around 17% per annum. Let's assume you phase in over 6 months. Your return then, maximum, comes down to 98%, so you're no longer necessarily going to get the 125. Your minimum return, minus 35, so no longer the minus 48. But look what happens then to your average return over time. It now is only 14.28. You're no longer getting that 16.91. You're no longer getting the benefit of the actual lump sum at the beginning. But hey, if it makes you sleep easier at night, maybe that's not a bad thing to consider.
Wow, 50% loss as opposed to 125% return.
No, I mean, the numbers
it's
are
emotional.
startling.
I mean, I'm just thinking how I would feel.
Absolutely, but I mean, it comes back to greed and fear every single time,
Yeah.
because that's what drives all these investment decisions. So, yeah, if I'm going to make this decision, what I need to understand is what is the likely consequence of this thing. Now, if I am going to phase in, yes, I will get protection. I'll get slightly less returns, and I will be significantly sacrificing my upside if there is a strong positive market movement over my phasing in period. Point number one, how bad can it be? The table shows us exactly how bad can it be. How much do I want that? And how much do I want to protect myself against the minus 48, versus minus 35 odd? And for that additional 11%, am I prepared to sacrifice the upside? And the reality is how each one of us answers that question is going to be very, very different. The most we can hope for is to understand what we're opening ourselves up to if we're going to consider phasing.
So last comments. Roland, let's start off with you.
I think you have to decide in terms of what kind of person you are. I think that is key. If you get a lump sum, are you tempted to use that lump sum for bad use or for good use in terms of investing? If you are tempted to use that money, it's probably best to put it all in the market so you keep your fingers off it. The other option is that you put it in slowly. As you get it, you put it away. So I guess that determines.
And also, I mean, if you're 65, you've got to realize how many more years you need to
live.
have funding for. Yes, live.
Good and
I'm so
bad
glad
use.
you said it.
Where did you get those words?
Last comments, quickly.
Okay, all right, look at your screen. There's some last comments on South Africa snapshot. Investing in equity should be a long-term decision. Again, exactly the same as what we've seen in the international context. Phasing in outperforms lump sum investing only about 40% of the time. Phasing in is a risk mitigation strategy, and that comes at a cost, and that is certainly something that everybody should take into consideration. In phasing in occurs, the most optimal time period is within 12 months. So don't try and phase in over more than 12 months. Certainly the research doesn't show that necessarily adds value.